Did you pick a stock with strong earnings growth and still saw your stock fall close to 50%? Then you should watch this video. Yes, we are talking of stocks that showed sound earnings growth and had a tremendous pickup in momentum of earnings over the last couple of years, and it would not have delivered for you. Take a look at this. Divi's Laboratories, a market favorite and even a favorite for mutual funds. Look at the fall, that's over 40% since its peak in November 2021. And you do know that COVID was a big trigger for the stock. Look at Aarti Industries at a time when specialty chemicals, there were a lot of IPOs, and all of these stocks really hit their peak and showed tremendous growth in earnings. And then there has been a fall. And please remember, this is not just a fall in the price of the stock. There has been a contraction in either earnings or a slowdown in sales and a contraction in margins. Another example, diagnostics. All of us had to get tested for COVID, and invariably we thought these diagnostic stocks were going to do well. And yes, they did. But look at what happened, a very steep fall since the peak in November or December 2021. What's common between all of these stocks is a very simple thing. Most of the stocks that we saw that rallied, over the COVID period or just pre-COVID, because we thought the changed environmental and social situation would add momentum to these sectors, had hit their peak earnings, and most of us had extrapolated that their earnings would continue. And when that didn't happen, the market really pulled these stocks down. You can name the sectors: IT, pharma, chemicals, diagnostics. These are just some. There are many such, all many of the stocks in these sectors saw a decline of 25 to 50% from their peak, and most of the peak had happened, around October, November. It was not just a peak in their prices. When I speak of peak, I speak about the peak in their own earnings growth, the trajectory of their growth. So here's the example with, I'm going back to Divi's. Divi's, you will see that the stock had seen peak sales by Q3 of FY22 and Q4 of March, 22, and then there's been a steady decline, and operating profit margins plummeted from the peak, right? What went wrong is that when there was this sudden growth, the market started extrapolating these short term shifts to be sustainable over the long term and started valuing the stock or assigning P's for the long term. And when that did transpire after the opening up for various reasons, you know, stock saw a correction. So you had entered thinking that there is strong earnings growth, nothing wrong, but none of us thought about the sustainability of such growth. And that's what happened with these stocks, right? Um, I'm just going to take, these are examples when stocks that were extrapolated with high earnings, disappointed the market. But there are other post-COVID challenges also that the market faced and investors faced. Let's take a consumption as an example. When we were all locked down, there was a lot of pent-up demand. We weren't going out, we weren't shopping, we weren't buying fancy clothes or shoes. So there's a lot of consumption pent-up demand, and people believed that this pent up demand will really jump post opening up, and that would cause a significant increase in the sales of retail players, whether it's clothes or footwear and so on. But here again, the trends have been highly deceiving because stocks even in the same sector were moving in wildly opposite directions. Let me just take the example of Bata here, right? You can see that Bata has always been a very favorite stock among investors, especially when demand surges. We sit at home, we didn't buy footwear, we start going out, we want to buy more footwear, so we expect Bata to do really well. But look what happened. You can see from this graph that I have here that the sales growth, is barely in single digits over this past period, and the stock gave up 30 to 35% from its peak, right? With contraction in PE multiples from 80 times to 55 times, right? So this trend, kind of was a negative trend for Bata. Nobody expected Bata to do this badly. Everybody thought, Bata would see an increase in sales. The stock in the last year, fell by about 30%. But at the same time, another brand called Metro Brands, you all know it, you know, Metro Brands is on its way to almost clocking 50 to 60% growth, going by the past 9 months numbers, and look at the stock price increase, 36%. Look at the difference. One stock that falls over 30% and another stock that has delivered 36%. And you thought you got the pent up demand thesis right. Yes, you did get it right, but not with the right companies. So let's look, right? The pent up demand did play out, but there was a different consumption behavior that happened. Premium consumption trend picked pace over the value consumption trend, right? Metro operates more in the premium segments. It has brands like Mochi, Crocs, Metro, many of you may be familiar, right? So people started buying more aspirational or premium goods than the regular ones, and therefore while the trend played out right, it was not in the right stock. There are many such examples actually. If you take Jubilant Foods versus McDonald's, Jubilant Foods is your Domino's Pizza versus McDonald's. Most of us, believed that Jubilant Food would do well because of, in-home consumption. Over COVID, this stock started rising because people would order more food home. They can't go out. But what exactly happened, once the opening up started, was that out of home consumption started picking up, but people started assigning too much value to the in home consumption and thought extrapolated it to believing that the earnings growth would continue, and that didn't happen, right? So these are several examples. I'm just giving you a couple of examples here. There could be many such examples where you think that any short term trend can play out over the long term, and you actually enter when the growth is sound and you still get the call wrong. So here are a few things that you could, check to avoid these kind of errors, to avoid this kind of losses in stocks. So look at how, the recent spike in the stock has been and what is driving that rise, right? There can be a reason, there should be a reason, and if that reason is really earnings expansions, great. If there is earnings expansion, what sort of expansion is that, right? Is there an increase in order book or a changing cycle? For example, commodities have their own cycles. There is a shift in cycle in a commodity, there is an uptrend, and that's very natural. So your stock goes ahead, that is fine, and the earnings catch up later. So what is exactly happening? Is there any unusual growth in sales, and can you identify it to be structural or temporary? When I say structural, for example, if you take a company like, say an ABB or Siemens in the capital goods, they have been moving to more digital solutions. Their growth, ABB's growth, has been very strong, right? There is a structural shift in its business focus. But if something is temporary, like the diagnostics, like the pharma, if a COVID drug was giving sales to a company, naturally post COVID, that sales has to fall. So you can't simply go by the strong sales growth and earnings growth in these stocks, right? And the very important thing for you is whether there's been a sudden deviation in the margins. The operating profit margins are really important. If a company is able to see a sudden increase in the margin, what really changed? Is there a temporary factor or is there a structural factor? A temporary factor like diagnostics, seeing high margins during COVID is nothing unusual. As in, it's a temporary spike. It's not a structural change. A pharma company doing well because one or two drugs, some of the zinc supplements that it has, or a specific COVID used drug that it has grown fast, then that margin can't sustain, right? These are the questions that you ask yourself when you see strong growth. You can't just say this company is having strong growth, I will enter it now. And if you're entering it at very high valuation, more reason why you have to question yourself. And that leads us to the last point. Does the current valuation still look reasonable due to this sharp spike in earnings? More often than not, the market is willing to assign very high valuation, when there is earnings growth, but it does not think too much about the sustainability of the earnings growth. And that's what transpired entirely in the past 2 years, and need to be cognizant of those. But on the plus side, Many of the stocks that I showed you here have fallen and steeply. Many of these sectors are now seeing stocks where the froth is removed and they may have attractive valuations. So it might call for some kind of a shopping at this time. And where do you look for those stocks? Look for those stocks with prime stocks. Do check out prime stocks, and do also check out our stock screeners where you can actually select stocks yourself where valuations have fallen and where earnings growth is still there.